slides here. Yeah. Want to welcome everyone to this introduction to Statement on Auditing Standards 136, what we call SAS 136. We're going to try to go through this. Some of you may have heard about the new auditing standard for employee benefit plans that's coming live this year. Some of you maybe have heard about it because you got invited to this webinar. But our goal today is to try to demystify this a little bit for you, explain what exactly it entails, what it might mean for you and your audit this year. And hopefully if you've got any anxiety about it at all, we can help sort of relieve you of that, especially if you're a plan sponsor. And of course, we know we've got people, just kind of looking at the attendance list, we've got clients here, we've got plan sponsors here, we have service providers here, whether they're third-party administrators, record keepers, wholesalers. So great to see just a lot of people from the retirement plan community involved here. You know, I think we're, some of us are in the afternoon already. I saw some people that are East Coast, and then I've got a couple people that I think are just down the street from me right now. So anyway, just great to have everyone here, and great to see you too, David. It's glad to see you on here. Just real quick, just who are we? Why do we have anything to say about employee benefit plan audits, things like that? John and I started pension insurance in 2014. It's hard to believe it's been 7 years. We've been working together doing benefit plan audits for, I guess, 7 years before that. Really, we had just kind of wanted to create a firm that did benefit plan audits exclusively. I think we're expecting to audit somewhere close to 700 plans this year. And of course, so because of that, and kind of my role in the firm is sort of the technical partner that's in charge of making sure that we comply with new things that are coming out. And so because of all of that, SAS 136 has been on our radar for a few years. And it was actually a year later than we expected because of COVID. Let's see if I can get to I'm remote controlling John's screen, and sometimes it works and sometimes it doesn't. John, can you click me to the next slide? Thanks. What we're going to kind of get into today is just, hey, why are we having SAS 136? Why now? Why does this come out? What does it mean for me, especially for those of you that are plan sponsors, and those of you that in turn are helping plan sponsors? You get kind of an understanding of what's required for them. So let's just start out with some lingo. I don't know why accountants love acronyms so much. We've got all these things, and it just got worse with this new SAS 136. But we'll just kind of walk through these. Some of these you might be very familiar with. Some of them might be very, very new. And some of these terms get used in specific ways in SAS 136. So I thought it'd just be helpful to kind of get our heads into the game by talking about some of this lingo that might show up later in the conversation. So to start with, I mean, probably many of you are familiar with the Form 5500, which is the annual tax filing that you have to do for your employee benefit plans. And that's if you're an audited plan, that's where you're going to attach the audit report. And, you know, the main thing that SAS 136 sort of requires that maybe wasn't there before is that when we look at the 5500, we need to have what's called a substantially complete 5500. All that really means is that all the important schedules that would be relevant to my financial statements, I've got pieces of those in the picture. I can look at those before I issue my report. ERISA plan, pretty obvious there. It's just an employee benefit plan subject to ERISA. And this next thing, this ERISA section 103A3C audit. I've been practicing saying that for a few years. So I'm getting it down now, 103A3C. It kind of rolls off the tongue once you get it. But if you've done audits before, you might have heard the term limited scope audit. This is kind of the new lingo for limited scope. You know, it apparently was confusing what a limited scope audit was. So ERISA 103A3C is supposed to clear it up. I guess you're supposed to go look that up in the law itself or something like that, so you can know, which I've done, and it's I'm not sure that would help you. But in any case, it basically is what used to be called limited scope audit. And the main thing with the limited scope audit is that let's just skip to this qualified institution here. The main thing with limited scope audit is that you've got a qualified institution involved with your plan. They're either holding plan assets or they are providing benefits under the plan. It's going to be a bank or a trust company or an insurance carrier that's regulated, and they're preparing the investment information regarding the assets of the plan and providing you with what's called a complete and accurate certification. And that allows us, when we're doing the audit, to skip over doing a lot of the extra test work around the investments that the plan is holding. That information will be certified by this institution, and that allows us to just focus our audit on participant transactions, the contributions, the distributions, things like that. And that saves you a little bit of money on the audit as well. A couple other lingo things. When it's a common term in the auditing standards for years is the term management. But there's never been an auditing standard that actually addresses retirement plans. And so it wasn't always clear who exactly is management in a retirement plan. SAS 136 makes it clear that at least included amongst management is the plan administrator. And so that kind of gets, you're now under the umbrella of being in management if you didn't feel like you were before. Plan instrument should be relatively obvious, but this is your current documents. So if you've gone through just a recent restatement, that plus any amendments is basically going to be considered the plan instrument. So it's usually called the plan document, plan instrument in the singular, but it may refer to actually a collection of documents that you've got hopefully somewhere that you can locate. I'm going to turn things over to John. He's going to kind of start us off talking about the purpose and background of SAS 136.
Yeah, well, so we'll start talking about this. And the objective today is, we know you're listening in, not plan sponsors and service providers. We're not going to get technical into the actual auditing standard and what it, for like auditor speak, what it means. We're going to kind of try to address more how you would interact with it, what changes you would see, things like that. If you do have any questions, please go ahead and put them in the chat box. Nathan and I will be checking that to see, if we can address any questions you have. But yeah, so we'll go ahead and SAS 136 is interesting because it's really the first auditing standard that focuses on benefit plan audits. Benefit plan audits have kind of always been this rogue audit that, tried to adopt, it kind of thread the needle of, following the auditing standards, which it has to, but at the same time, we were kind of subject to the, what compliance risk areas the Department of Labor, was kind of insisting that we look at as well. And so it's always been a little bit of a tricky spot because at the end of the day, it's a financial statement audit and we need to follow the auditing standards, but we know that we've got, kind of what the expectations are from the Department of Labor, who regularly looks at our work papers. And so we know what they want to see as well. So SAS 136 came along and it's an auditing standard just for benefit plan audit. So it tried to kind of clarify, what kind of give, a home for the benefit plan audit within the auditing standards. And so that's what SAS 136 did. It was originally issued July 2019. It went into effect, it was intended to go into effect for plan years ending after December 15, 2021. So that would have been the, it was initially intended to go in December 15th, 2020, and now it got delayed a year for COVID. So it kind of made some things a little confusing. When I'm going to show a slide on the 5500 that kind of last year, everybody was scratching their head and the Department of Labor actually had to kind of step in and give us some guidance, which of course the auditing community challenged because it wasn't quite to the letter of the law on the auditing standards or financial reporting standards. But anyways, so we were kind of in this weird hybrid model last year where there was partial adoption, but it wasn't really mandated until now the 2021 plan years, which are the audits that are happening this year. So the new auditing standard, so it was intended to enhance the quality of the ERISA plan audits. I'll share some slides. Every time we present, we always talk about the Department of Labor audit quality study, which we can't resist. And so we'll talk about that because that actually set the course for now 6-7 years later to us having this standard. So the idea was the audit quality, auditor quality wasn't up to par, and so this was supposed to enhance that. We wanted more transparency, or the AICPA, the governing board, wanted more transparency in what ERISA plans cover and what they don't cover, or what the ERISA plan audit covers. And then it's kind of also who does what. What's the requirements and what's the responsibility of the auditor, as well as what are management's responsibilities in governing and the financial reporting of the retirement plans. So a couple of key things here. So on SAS 136, we're going to address, this is more of the why, and then we'll get into a little more of the history. So as again, we'll look at some slides that talk about the ERISA audit quality study. They've been keeping an eye on it. It's because it's been trending the wrong way. And so they've been very interested because Title I of ERISA, they wrote in that, for protection for retirees, that we'd have these independent CPA firms come in and do a financial statement audit and report on the financial statements. And so that's built into Title I. So the Department of Labor is very interested to make sure that's happening the way it was intended to happen. Dual audit quality studies have found large numbers of firms doing some standard work. Again, in a couple of slides, we'll go ahead and look at exactly kind of the breakout and the statistics of the specifics of who's doing what and who's not doing what and what kind of deficiency rates we're seeing. We'll look and we'll see, you'll see the trend within the deficiency rates as far as what firms are more committed to this and kind of the similarities they found that kind of identify a quality firm. And then ultimately, if you've been doing audits as long as Nathan and I have, it comes up all the time when you're just talking to other auditors that maybe just do a handful of these, or maybe they don't do them. They kind of say, oh yeah, benefit plan audits, those aren't real audits. Those are all limited scope audits. And so there's kind of this misconception out there that these aren't real audits. It's funny because in the audit community, there's this misconception that these aren't real audits, they're limited scope. You don't issue an opinion, therefore you don't have to do anything. And then kind of on the other side of the spectrum is, I think there's probably plan sponsors out there that think these are full compliance audits and they catch everything. And the truth is in the middle. These are real audits. We are following auditing standards. We are issuing a report on financial statements. So there's a lot of work that needs to be done and documented to support that. But at the same time, they are not compliance audits, and we're not going to catch every single small earnings code or something that might get missed. So a real compliance audit would be very expensive if we were to basically provide 100% assurity on every transaction and every dollar in that plan. So what SAS 136 is trying to clarify, that, hey, these aren't limited scope audits. These are full audits, and they do have a scope limitation, and they just want to kind of identify that and break that out a little bit more. So here's the audit quality study. This is a slide we commonly share because it kind of tells a story of why we're here talking about SAS 136 today. Is they kind of every decade or so, they kind of just look at what they do a sample. And the last one they did was they did in 2014, released it in 2015, and they sampled 400 plan audits. And they looked at the work papers, and they started identifying, where they saw deficiencies, where work wasn't properly performed or documented or both, and they made note of that. And so when they released the study, it was, I'll share the next slide where, it talks about kind of where the deficiencies really lie. But the trend here, as you can see, is pretty alarming. That you go from the last 3 studies, you went from 19 to 33 to 39. We've essentially doubled from 2 studies ago, and they're currently undergoing another study, is my understanding right now. So we should expect an updated study within the next year or so, and we'll kind of see where we're at. So here's the trends they found, and we've shared this quite a bit, so this might be repetitive for people who have attended any of our webinars, but it really is, it was kind of the reason for pension assurance where we started the firm, and it's really kind of a big concern out there, and it's driving this additional work, this SAS 136, things like this. But what they found out is that the one identifier for these deficiencies was primarily around the number of plans that a firm audited. And that's for a few reasons. It was a demonstration of their commitment. So if you've got a firm and they're doing a couple audits, they're not really committed to it. And I've experienced that in prior lives where, you see a firm and it's kind of a sub-service, very minor service, keeps the staff busy during the summer, and that's about the attention it gets. You don't really have somebody staying on top of it. You don't have a Nathan who's on top of the auditing standards years before they go final, and able to kind of make sure that everything's up to date and that we're in full compliance with everything. So you saw that on these smaller firms, just less commitment. Also, a lot of the smaller firms, you're not going to have the internal control infrastructure or quality control infrastructure, where it's a sole practitioner or a very small firm. You might have 1 or 2 people looking at it. If it's a sole practitioner, you have 1 person looking at a file. I know our audits go through 4 levels of review, from preparation to then 3 levels of various oversight. And we see things all along the way, even up to that 3rd and final review, we're still catching things. So, it's very important to have a good quality control infrastructure where a firm's committed to it and they're up to date, they're investing resources into it, they're training their staff, and they've got a good planned out quality control that's gonna capture the audit and look at the audit from different angles and different elevations and things like that. So this is really was very alarming to the Department of Labor. When they came out, we were actually at a big conference, and they were not happy, and they gave us an earful. And we had over 1,000 CPAs in that conference, and they told us things have to change. So we've seen a number of things, and this is where it actually finally hit an auditing standard, where they want to see change, and they feel like this will drive change. Let's see. Okay.
So John's kind of covered the Department of Labor, kind of their side of motivating SAS 136. I'm going to kind of talk a little bit about the profession's side of that. But before completely moving on, that last slide that John shares, the thing that comes to my mind when I see that sometimes is, this is why we can't have nice things. And, if you've experienced as a client fee increases over the last few years, or just even additional requests or things like that, you can think all of this environment. And sometimes I've had to explain fee increases and explain, the DOL has been chasing the profession for years now, pretty much ever since that audit quality study came out, and really been trying to raise expectations. And, I think there are some good things about SAS 136, that it kind of clarifies some things, which is helpful. I think one thing I can say that I'm happy about SAS 136 is that the profession didn't give the DOL everything on its wish list. There were, when we first started seeing some of the things being proposed, it was a little bit frightening. And we were thinking, gosh, the fees are going to go up insanely. These audits are going to become a lot more risky to do. There's going to be a lot more just difficulties and challenges. Luckily, I think what the profession, ultimately, when I talk about the profession, the CPA profession is a self-regulated profession. And so we have an auditing standards board that issues these. So these are sort of, they're kind of playing a little bit of you might call it a political game, because they're trying to keep the DOL from coming in and saying, oh, we can't trust you to regulate yourselves, while also sort of trying to stay true to the auditing standards and the concepts that we are used to as CPAs. And so they had to really kind of work that out. But I think they came up with something that's quite sane, relatively speaking, when it comes to some of the things that have come out in the past. So basically, what SAS 136 does from this auditing standards point of view is that there's never been any guidance specifically addressed to employee benefit plans. There's been accounting standards for years that kind of tell us how to account for different things in benefit plans, but there's never been anything that gives us specific guidance on how to audit the plan. And because of that, you kind of have a little bit of a Wild West environment where some people think, oh, I don't have to do all these things because it's not really directly related to the financial statements. On the other hand, you have the Department of Labor expecting perhaps many, many things that really couldn't turn into anything that would ever materially impact a financial. And so, it's kind of hard to figure out as a firm, where should we be targeting? And I think the trend for a little bit there was just like whoever had the most extreme views about what's expected, kind of carried the day. So SAS 136, I think, sets some guardrails, and clarifies where some of these things fall. For instance, what's the role of the plan document? Pretty central to our audit methodology for years has been, we see the plan document as one of the key things that drives risk in our audit. Based on what types of provisions you have, that tells us what our audit risks are. If you don't have, say, an employer contribution, well, there's a certain set of risks that I don't have to worry about in the plan. If you have a certain vesting schedule, well, that raises a risk. What if the vesting schedule is not followed? And so on and so forth. And so understanding the plan, at least to us, has always seemed like it's pretty critical that we need to read the plan, understand the plan, and do risk assessment on the plan. But that wasn't really specifically spelled out in the auditing standards. And so, some of those deficiencies that the DOL is finding have to do with auditors not being familiar with the plan document. And so SAS 136 makes it clear, hey, when you're doing risk assessment, when you're evaluating the plan, you've got to understand the plan document. Another thing that's been interesting is what is our responsibility? John kind of mentioned all of the compliance aspects of the 401k, and they are just, or whichever kind of plan you have, the compliance aspects just, they sprawl everywhere. And some of them, from a financial statement perspective, are not very big. Some of them can be in certain situations. And it's not always been clear where exactly our responsibilities start and end with respect to compliance with the tax code, compliance with the plan document, whether you have late contributions, all those types of things. And luckily, SAS 136 gives us some clarity there. So let's get into some specifics here. I think we talked a little bit about terminology. This is kind of a roadmap, just what we're going to go through for the rest of the training here. We're going to talk about the auditor and management responsibilities. And again, this thing about what do we do with findings? What are findings? What are some common findings? And then when we close out, John's going to kind of show you some of the changes that have happened to the audit opinion from SAS 136. But probably the first place to start is just kind of at the beginning of the audit. And I think SAS 136 sort of makes clear some responsibilities that I think were implicit before, but now they are codified in the auditing standard. They're going to be codified in your engagement letter. So if you looked at your engagement letter this year, you probably noticed it was longer than in the past. When you get your auditor's report, which John's going to share later, you'll notice that it's longer than in the past. And that's because all of these responsibilities are being spelled out explicitly now. So one of them is maintaining a current plan instrument, including all your plan amendments. So you probably have some of the service providers that are even on this webinar right now. They're probably people helping you do that. Ultimately, you're responsible to monitor and make sure that happens. But maintaining a current plan instrument is management responsibility. Administering the plan, again, you can hire people to help you to do that. You can even outsource some of the responsibility, but you've got to make sure that that's being competently done. Determining that the plan's transactions in the financial statements are in conformity with the plan's provisions. So if you've worked with us on an audit before, at the end of the audit, we send you the financial statements and ask you to look at them. And that's one of the responsibilities you have as management. Maintaining sufficient records with respect to each of the participants to determine the benefits due or which may become due to them. Now, that's a responsibility that's in ERISA, actually, but it's now part of the auditing standards, part of the engagement letter you sign. And so that's something to think about. A lot of times you might have third parties involved. What happens to those records if you change third parties? Are you going to have access to those records if you change payroll provider or you change record keeper? It becomes a problem in the audit if I can't access your payroll from a year ago or something like that because you changed providers and your provider locked you out. And so that's something to think about if you change providers. As well, if you keep any of these forms at your office, making sure that you've got a good process around, hey, if I'm an auto enroll plan and I get paper opt-out forms for someone to opt out, I've got a form from everybody who's not auto enrolled in the plan. Things like that, just making sure that I've got records to show, hey, these participants, this is what benefit they're getting. Here's the paper trail or the electronic trail. Whatever it might be, and providing the substantially complete Form 5500 that we talked about at the beginning. Now, let's talk about ERISA 103A3C a little bit more specifically, because there's another set of responsibilities that management has if an ERISA 103A3C audit is being performed. And, as I had mentioned, this is kind of the old school limited scope audit. It's a little bit different in some ways, but the basic idea is, again, that we're going to scope out. We're not going to test. They're trying to get away from the scope limitation language. They're just saying it's a special kind of audit for ERISA plans. But in any case, we're sort of confining ourselves to testing anything that's not certified investment information. So in a ERISA 103A3C audit, management is further responsible to make sure that that type of audit is permissible, and that the investment information is prepared by the certified qualified institution or certified by a qualified institution, that the institution itself is qualified, and that ultimately that the certified information is appropriately measured. Most of the time, that's not too much of a difficult responsibility to fulfill, because if your plan's holding something like mutual funds, there's not really any sort of creativity to valuing those. But you might have something more complex in your plan. That's where that responsibility may come in. I put this in here because what we've kind of seen is, and when I first read the standard too, I thought, oh man, do we have to send out a checklist or something and have the client, verify that they've taken responsibilities? But there's a few things to understand. One is it's already in your engagement letter. If you sign your engagement letter, you've already sort of assumed these responsibilities and instructed us to do the ERISA 103A3C audit. And there's nothing in these responsibilities that means you can't ask your service provider, you can't ask your auditor and say, hey, we have a qualified institution, right? But you're not violating any rules or independence if you ask us that. And most plans are with providers. I mean, again, we're auditing so many plans that we see most providers. We already know, yeah, this is a qualified institution. We're going to get a certification that we need. So, these responsibilities, ultimately, they are yours, but don't worry too much as far as like, did I meet those responsibilities? My audits, David saw it's already done. Don't worry about, did you meet that? Because in some cases, this is almost a little bit of a trivial thing.
I think what it was intended is just to put some ownership back on the plan sponsor to basically know your service provider. Nathan, a couple questions. One would get us in trouble, so we can't answer it, but it was, who's the best record keeper for auto enrollment electronics documentation. But feel free to reach out to us privately and we can give you our experience. Another one from Harvey, any difference with plans with some assets that are certifiable and others that are not?
Yeah, so we have a few plans like that. And, basically we'll still have to do what I'm just going to call full scope procedures on the non-certified assets. We'll still have to subject those to testing. And then it'll still be considered to be an ERISA 103A3C audit. You'll just have a component that's kind of carved out as far as, we're going to subject those to the full scope testing procedures that we do. But once you sort of have one institution that's material, that's under ERISA 103A3C, then that sort of colors the nature of the opinion as a whole. And then you'll have a footnote in the financials that basically just spells out which investments are actually covered by the certifications. And then by inference, the remainder is not. So that's the answer to that one. And speaking of certified information, this is kind of what you want to see on a certification. We definitely check this when we do our audits, so you don't have to worry about it too much. But one, is the institution qualified? Does it have a signature from one of their authorized representatives? You got to have both the words complete and accurate. You can't have just one or the other. And it's obviously got to cover the right plan and the current period. So those are the things that we look for in the certification. Management representation letter, that's going to be another change that you're going to experience at the end. Again, I think it's a little bit longer this year. And it really is sort of a recital of the same responsibilities we just talked about, except now it's in the rep letter. So you're at the beginning, you're signing and agreeing, yes, this is my responsibility. At the end, doing the representation and saying, yes, we've fulfilled all those recommendations. The last thing I want to share with you is just what SAS 136 has done in reportable findings. And if you've gotten a letter from your auditor basically saying, hey, you've got some things to correct in this plan in the past, a lot of times it's been kind of explained in terms of an internal control issue, because that was kind of one of the primary things that we had to report findings about. SAS 136 kind of gives us a few different buckets that we can now sort of report on these things under. One is an identified instance of noncompliance or suspected noncompliance with the Internal Revenue Code or the DOL rules. This could be stuff like you didn't remit contributions timely to the plan, or you didn't follow the plan's definition of compensation. Those are two very common noncompliance issues that come up in audits. So that could be something that gets reported. Significant deficiencies in internal control are still relevant. That'd be like an example where you have someone doing bank reconciliations, but no one reviewing beyond them, which is, I recommend that you fix that if you've got that situation. It's not the safest way to manage your cash, but that might come up in our interviews and we may give you a recommendation about that. And then anything else that's significant enough, and that's kind of based on auditor judgment. But in the example I gave earlier, where maybe you don't have sufficient documentation around your opt-outs on auto enroll, that might be something that we want to elevate and communicate with governance. These reportable findings don't go in your audit report itself. It's an internal communication with management, and basically as us, we're required, if we come across any of these types of things, we're required to communicate them with you at the end of the audit.
All right. Yeah, and just to clarify, as Nathan just said, that is just an internal communication and fairly common, so nothing to worry about.
Don't file it with your 5500.
Yeah, don't. That happens sometimes. It gets uploaded.
We always intentionally send it separate so that you don't do that. So
yeah, exactly. And usually a little after we know the filing went through. Okay, changes to the audit opinion. So this is somewhere where you'll really see the impact of SAS 136, as you'll notice in the audit opinion. There's just more information there. It's more, as Nathan mentioned, kind of just spelling out who's doing what, responsibilities, what the intention of the audit was, and what the audit did and what it didn't do. It's also kind of a good way to, it might be late because it's at the end of the audit, but if you do see, and I'll show the two examples of the audit opinions, if you see the old audit opinion, that's an extreme cause for concern. It means that they're not following SAS 136, which is a requirement for the 2021 audits. So if you'd see that, that'd be a conversation you'd have to have, because you wouldn't want to file that financial statement with the old audit opinion that's pre-SAS 136. Most likely it will get flagged, and the auditor doesn't want that out there either. I mean, they'll probably get some kind of call or letter from the Department of Labor wondering why they're using that. So we'll go ahead and look at these two opinions. Kind of overall, as we mentioned, we're moving away. The intention was to move away from that blanket limited scope disclaimed opinion, right? Because a lot of people interpret that as, oh, we're not doing an audit, we're disclaiming an opinion, so therefore, it's low risk and nobody cares. So this will move that away. We're actually going to move to an unmodified opinion, which is the typical audit opinion you'd want out there. It's the opinion that gets attached to most financial statements, especially publicly traded company that's issuing their corporate financial statements. They're going to have an unmodified opinion. If they don't, they're probably going to lose a lot of investors, or something's going on. So the unmodified opinion is really kind of the opinion that you would expect to see on a healthy organization or a healthy retirement plan in this case. So we'll go ahead and see. Okay, so I put this in here. This is probably mainly what the service providers wanted to see, is how does this impact the Form 5500? So, if we see a lot of people drop off after the slide, I get it. This is why you're here. So this was kind of interesting because the COVID pushed back SAS 136, right? Delayed it a year. But it wasn't, the Form 5500 instructions were already updated. The new Form 5500 was updated. So last year we were in this situation where we had the updated Form 5500 Schedule H Part 3, which is the accountant's opinion, that was set up for SAS 136, but very few people actually adopted SAS 136 last year. So we're in this in-between world where technically we were still issuing a disclaimer, and then we had to identify the disclaimer, but the Department of Labor was like, well, no, this is intended for, we want to see what the true disclaimers are and what the true unmodified opinions are. So it was this struggle. We just basically, hey, Department of Labor, what do you guys want to see? Let's just do that. And that's, that was the mandate they gave us. We figure they're the ones reviewing this, so let's just appease them and not get put on a list. So this is the direction that we were given. So going forward this year, it's crystal clear. There's no question about it. This is how the accountant's opinion needs to be filled out. Now, I totally expect to see a lot of people still checking box 3A at number 3, disclaimer, because I think we're all, for decades, we've been stuck in this disclaimed opinion place. And so now moving to unmodified, which is what 136 did, it's going to take some adjustment. But going forward, you want to make sure that part 3, section A, box 1 is checked unmodified. That tells the Department of Labor and the IRS that these financial statements are healthy. It's an unmodified opinion. There's no disclaimer, no qualifier, nothing. If it is disclaimed, that tells the reader now that, hey, something's wrong with this. The auditor couldn't issue an opinion for some reason. And the one acceptable disclaimer is on the 403Bs. On the 403Bs for the legacy assets that can't be traced because they were individual annuities set up decades ago, and nobody really has kind of collective reports on those. So that's the one acceptable disclaimer. If that box checked as disclaimer, I think immediately whoever's reviewing these financial statements will go and look for that footnote that shows that, oh yeah, this is due to the 403B exemption that was actually permitted by the Department of Labor. Outside of that, you would not want to see a disclaimer checked on there. That will be a red flag. So should be checked modified. Now, where you get to report that scope limitation for the assets held at the qualified institution is in section B, and you check box 1 for that, and that would communicate that the assets were held at a qualified institution, and therefore we performed a 103A3C audit. So that's what it should look like, and that's what 95% or more of retirement plans file. I think we've always communicated that, and if anybody's unclear on that, most audits, most financial statements are previously known as limited scope because the assets are held at a qualified institution. So it's very common. It's actually, lowers the risk for being flagged by the Department of Labor. That's what they expect to see. So this is what they're going to expect to see going forward. They want to see that it's an unmodified audit opinion, and that it does have that 103A3C box checked, showing that the assets are held at a qualified institution. That's the best case scenario. When the assets are not held at a qualified institution, that could put you on a list, and they want to figure out like where these assets being held and who's holding them, what's going on. So something to note on the 5500. So we're going to kind of 2 takeaways is take a peek at the part 3 of Schedule H on the 5500. This is, this will be important. And then next is where we're going to look at the audit opinion and what changed and what didn't. Here's kind of a quick summary, and I'll go ahead and show you some examples. A lot of it's the same. It didn't change drastically. It's just kind of more spelled out, and there's a little more detail in there. So I'll show you the one from the current audit report we were using was 2 pages. When Nathan and I first started, it was 1 page, and I remember those days it was the 1-page audit opinion. And then we went to 2, and we're like, wow, got 2 pages now. We got to update all our page numbering and et cetera. And it seemed like a big deal. Now we're at 5. So that's page 1, 2, and we got 3, 4, 5. So typically you're going to see either 4 or 5 pages on the audit report. So that's what you're looking for. A lot of it's the same. It's just a little more detailed, a little more spelled out, the responsibilities. But the key is if you do see that 2-page audit opinion, and actually I think I saw a 1-page audit opinion just a few years back. So somebody kind of missed the boat from some auditing standards or reporting standards that changed probably a decade or more ago. So that's something to put on your radar, and that's unfortunately going to be at the tail end of the audit. So if you see that, you just need to have a really very strong conversation on what's going on and what's happening with SAS 136. But you all know about SAS 136 now, so you'll be able to have that conversation.
John, one thing I'll mention is that even though the audit report is longer now, I think it's a lot more intelligible. I think if you ever taken the time to read the previous audit opinions, that was one of the frequently asked questions is, when you read it, it sounded like we didn't do anything. And this kind of spells things out a lot more clearly. So it's a longer read, but it makes a lot more sense.
Yeah. So here's kind of the conclusion. We'll go ahead and wrap up and answer a few questions. So this is kind of the highlights of what's changing. It's just spelled out a little bit more. It wasn't revolutionary in the sense that it added a lot more work. Quality auditors were already doing a lot of this. It just added more documentation and how we kind of incorporate it into our audit file, and just kind of spelling it out, making it more transparent. So from your side as a plan sponsor or service provider that a plan sponsor is relying on, we just wanted to make sure everybody was aware of, SAS 136, the changes, what to look for. It's a completely different engagement letter. If you're comparing it from last year, if you're doing a red line, everything's changed. It's kind of a very similar message, it's just reworded. And most auditors just kind of use the templates from the AICPA, so I'd expect it would be pretty comparable. And then the Form 5500 has the changes, the audit opinion has the changes, and there's just changes on our side and how we document things and what, kind of what we're looking for, and then just making it more transparent on who's doing what. And I mean, mainly, all of this was mainly just to get away from the mentality of the limited scope disclaimed opinion, and they really felt like maybe that was leading some of these audit firms that weren't doing many of them just to kind of write it off as, hey, we don't need to really dedicate resources or training or, emphasis on these. So that's kind of it. I think we got some questions here. Question in summary, there is more work for you as the auditor, but no additional action items for the plan sponsor or provider. Is that correct? I'd say mostly, yeah. I would say, I think there's more ownership that's been placed on the plan sponsor mainly, and I'm sure service provider and the plan sponsors are leaning on service providers, so that would filter out to you. And a lot of that's kind of written in within the engagement letter of what they're basically signing that they're going to represent that they're doing on their side. From that sense, there is just more ownership. Is there more action items? Not really. There's nothing, auditing standards can't really mandate that, a plan sponsor or client or service provider do things. It's just going to mandate that we do things and we ask things and we document things. So I'd say that's probably a fair statement. Nathan, anything to add to that one?
Yeah, I mean, I think if your auditor did in the past kind of not apply these concepts, you might suddenly get a lot more audit requests than you have in the past. But I think if they were kind of doing what was kind of more expected, even though implicitly, then you shouldn't see a huge change in the number of audit requests.
Next question, how do you audit fair market value of assets such as limited partnerships? Can you disclaim an opinion if you can't get good values or qualified institution, I'm assuming? Nathan, you want to tackle that one?
Yeah, I mean, it depends on the situation a little bit, and it may depend a little bit on what they're holding, and also sort of how liquid it is, and if you were going to liquidate it, how would you get that value out? So there's a bunch of considerations there. I mean, a disclaimer of opinion, you probably wouldn't have a disclaimer opinion if you just got some some LLCs or something like that in there, unless it was like almost all of the holdings of the plan. If the auditor kind of decided that they couldn't really get solid assurance over those assets, it'd probably be more like a qualification of the opinion. Disclaimer is usually for something that's supposed to be pervasive, and that you would want to avoid that if possible, because a qualified or a disclaimer other than the 403B thing John mentioned earlier is definitely going to show up at the DOL side if that box is checked. So I would definitely encourage you to try to work with your auditor to get them whatever information they need to be able to audit those assets. But it's going to depend on the nature of the assets to what that would actually look like.
It's funny, we go to conferences and we always ask the hard questions and we always get facts and circumstances. It depends. Nobody wants to answer the question, which I felt like Nathan did a little bit, but I think he answered it. I mean, it really does depend. I mean, it depends on the size of the investment. If the limited partnership is a very minor investment, you could probably just scope it out and you wouldn't even need to really worry about it too much. If it's big, if it's held by a qualified institution, that's where you get into that 103A3C. But yeah, if it's floating out there and it's a big part of the plan assets, there needs to be some kind of valuation done. And that's actually a management responsibility. And it's just the auditor that's auditing that valuation, because we really have to understand the value of the retirement plan and the participants' accounts. Any other questions? We've gone a little bit over. Appreciate your time. Thank you so much for attending. And hopefully, if nothing else, take our contact information down. We got a lot of clients on here, so you know how to get a hold of us. But let us know if you have questions. We just wanted to kind of fly over at high level, put it on your radar, and just kind of the main things to be looking for. So thank you very much.